Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel L. Condon, along with Brianna Valesky, and we have Carolyn Boroden on the line. She's a commodity trading advisor and technical analyst. Carolyn, how you doing this morning?
I'm doing good. How are you?
Good. Thanks for coming on. Well, we always, like to ask our guests, how they got involved in the markets and what kind of path they took. And you have one I haven't quite seen before. You quit high school and you ran away from home. So, talk about that experience. And then your first job is a secretary gopher at the government bond trading room at DLJ.
Yeah, I never had any plans to be in this business at all. But I did leave home pretty young, and I was working a couple of jobs on Long Island, and my cousin said, there's no reason for you to be working two jobs. I have this interview you can have on Wall Street. So she basically dressed me up, took me to Wall Street, and I had an interview when I was 18 at the government bond trading room for Donaldson, Lufkin, and Junret, way back when. And they ended up hiring me, and basically I did start as a secretary/gopher, but they were all trading, and I had some people that said, hey, you like working pretty hard. Do you want to help me in futures? And that was the beginning to my career, and shortly thereafter, they sent me to Chicago when I was 20 years old, and I started working on the Chicago Mercantile Exchange.
Oh, really? When were you at the Merc?
Started in basically Eurodollars, Treasury bills, that stuff.
What years?
That was 77.
Oh, okay. All right. A few years before I got there.
Yeah.
All right. So talk about working on the government bond trading room at DLJ. I mean, back then you had to pick up a phone to make a trade, right?
Absolutely. I mean, I remember I was literally calling in orders to the futures exchange. I mean, you couldn't do anything via the computer at that point.
And what did you learn, back then, your initial that maybe is still, is part of your trading strategies or your trading philosophies?
Well, there wasn't that much. I mean, then it was totally different as far as being on the trading floor. And at that point, I wasn't even doing any analysis. What I was doing was sending in orders from some of the large banks and just getting orders executed. But because it was so interesting to me, I went and I took one of my first classes in technical analysis that used the textbook from McGee and Edwards. The technical analysis Bible.
And that led you to Fibonacci numbers. Before we get to that, did you look at any other methods or technical analysis strategies before you, settled on Fibonacci, or is that just something you came across? And I don't know, do you have a mathematical background?
No, actually, I was not really good in math at all. I'm thankful that the computers do it all for me now, but basically, I started looking at things like the basic patterns, learned a little bit about head and shoulders, pennants, trend lines. I liked doing some things like the action-reaction lines and the median lines because there was the geometry in it. Uh-huh. And I didn't really know what I was looking at that point, but then when I got a little bit more involved or got introduced to Fibonacci, once I started learning about how to apply that on both the time and price axis of the market, I threw everything else out the window.
Okay. And I mean, I know with Fibonacci, it's, 0.382 and 0.618, and they look at Fibonacci extensions. I don't know. Early in my trading career, a buddy of mine showed me the 50% retracement. And that's not exactly a true fib number, but is that something that, you figure into your analysis?
I really only use 50% when I combine it with other ratios. Okay. What I specialize in is looking for a confluence of ratios that come together at the same time. So, for example, I just had a recent trade set up in Apple where I had the confluence of at least 5 price relationships come together between the 105, 107 area. So when I see something like that, I know that it's important to look at that clustering effect for a possible change in the market. And we did actually trade down into that support decision and then almost turn on a dime.
Could you walk us through that trade? I mean, you had a 2 point area where you wanted to buy. Could you just give us, roughly like how you executed the trade, where your stop is? I don't know if you got out or if you had a target. Could you just walk us through that, please?
Yeah, sure. All right, here I'm actually looking at my 15-minute chart at the moment, and one of the things that I could see on this chart was that there was a nice healthy pattern of higher highs and higher lows since that washout low on the 24th. So one of the things that I did was I took the prior declines within this uptrend. So, for example, I had a $7.44 decline. That was a prior swing. I had another one that was $7.66, and I projected 100% of those declines from the new high that was made on August 31st. So that's where two of the price relationships came in. I also had a 618 retracement of another prior swing, a 1618 extension of another. So, it's basically taking every possible swing high and low on a particular chart and then running the price relationships that I use and then looking for that clustering effect. So in this case, when it gave me the cluster of 105.88 to 107.23, and I knew that as long as price held above there, I would look for buy triggers. Okay, and as far as a trigger, because a lot of people ask, it's basically price action that tells you that it's worth placing a bet against a zone. So in this case, it would be, let's say, a 3-minute chart. When we took out a prior swing high and had an 834 EMA crossover to the upside, that was the buy trigger. Okay, because the setup was done on a 15-minute chart, so I'm using a lower time frame chart to trigger an entry. Okay, and then once we knew that we had the entry signal, then the risk was defined either underneath the low that was made into the zone, which was 107.36, or if you wanted to get a little bit more room, you could actually put it, maybe 20% not 20%, but 20 cents underneath that cluster zone, so underneath that 105.88 area.
Okay, and so you have your longer term time frames, and then when you're looking for your entries, you really narrow it down. You said you narrowed it down to the 3-minute chart for your entry and stop. Did you have a target? You still in it? You're moving your stop up?
Well,
how you playing it now?
Yeah, I definitely like to move stops up because you can put a target out there and have an idea of where it might go. But I think it's better to trail up stops because there are a lot of times where the market will give you more than what you expect. So the initial target on this trade setup was 116.48, which is the 1272 extension of the swing into that cluster zone. Okay, and I'm not sure that wasn't met yesterday. It looks like we got up to 112.33, but I do like to trail the stop because you may get that target and then some. Mm-hmm. Okay, so I think it's a better way to go rather than just exiting, because I've seen it happen so many times before where the market will give you so much more, and you're like, oh my God, I just left so much money on the table.
Yep, that can happen, especially in these markets. So I know you have your book, Fibonacci Trading: How to Master the Time and Price Advantage. That was published by McGraw-Hill in early 2008. Let's just going back to Fibonacci in general. I see one of our chat participants said, I'm never going to be a Fibonacci trader. I mean, what would you say to somebody that was looking to get into the markets, was looking to study technical analysis? Why would you, obviously you've had success for it. Why would you steer them, into learning the mechanics of Fibonacci trading?
Well, I think it is, you can identify trade setups that are relatively low risk, high probability, as long as you do want to stick with the trend trade setups. But if you do that within, the context of trend trade setups, I think that they're going to have more of an edge than anybody else does have. I know there are other awesome methods also, but you definitely have an edge if you use Fibonacci both on the price axis and the time axis in this way with the clustering effect, because it's not just a single level. It makes a huge difference in how some of these setups can play out, and plus it's pretty precise. And the better news is that you know when you're wrong, because if it doesn't hold the zone, you're not going to say, oh, I hope, or maybe this will turn around and still work for me. You know when you're wrong, and you have to have that discipline. You have to know and define your risk. I mean, that's really what is going to help a new trader out.
All right, so let's put this whole move. I know we mentioned before you came on the show that you filed the S&P 500 futures, and boy, there's a lot of retracements that we could figure in here. For me right now, I'm one of your 50% guys, and my key level, we've had the all-time high at 21.26 and a quarter. We had our washout low at 18.31. I didn't have time to figure out any retracements when it hit that. To me, 1878.50. That's the 50% retracement. We spent some time above that. A couple tops at 1990 as well. So how are you putting this big move into the proper perspective, and what will you be using to determine that, this is just one of these corrections in a bull market, as opposed as maybe the tide has turned and we're maybe coming into a shorter term bear market?
Okay. Well, one of the things that I've noted, and I've posted on Twitter before in the past few months, and actually quite a few months, is that the S&P has reached a major 1618 extension off of, the 2007 high to the 2009 low. And we have not been able to push through that. So that was one of the areas that I put out there, saying that, if we don't get through this, then the market's vulnerable. And the reason why is because if you look at multiple charts, and I've looked at thousands of charts over the years, you will find that many moves tend to terminate at extensions of prior swings and also give you deeper corrections at those points. So that's in the background, okay? The fact that we do have a key high in place, and the market will remain vulnerable if we cannot clear it. And then within the context of the larger charts that I look at, I'll then take it down to, the daily and the intraday. And for example, we did hold above what I call a symmetry projection. If you look at the monthly chart of the S&P, and I can post this again later, but I have posted this chart where the prior larger declines within the uptrend that started from the '09 low, I had a couple of similar swings. I had a decline of 277.06. I had a decline of 295.81. And then the decline into the recent low was kind of similar at 267.71. So I'm kind of looking at that as far as a line in the sand, because so far we're holding above those symmetrical projections, which come in, let's see, the low end comes in at 1838 via the S&P. So if we can continue to hold above there, then, you can look at the buy triggers, okay? But the day that we take that area out tells me that I have to consider that we could get a much deeper downside correction, something that could be similar to the swing that we saw into the '09 low. So again, taking it one decision to the next.
Yeah, but right now it just doesn't. Short term as I can be in my trading, we're 120 handles off that low. It just, we dipped into the 1900s on Tuesday, I believe. I don't know. It just doesn't seem like we're ever going to get there. We're going to get back down that low. And I think you're kind of seeing that mentality in the market where, the dip that we had on Tuesday under 1900, boom, we just, rallied over, 70 handles this morning when we hit 68.75. Just have a question about your charts. I know you got a lot of calculations. Do you have this programmed into your charting system? So, there's, to do all this work by hand, it would probably be nearly impossible. Have you designed program? Yeah. Do you design, systems on your platform that, boom, well, if I wanted to do, apply all your studies to Apple, I put Apple in there. If I want to apply it to the S&P, I put the S&P in there. Is that the way you do it? You spend some money with some
Nope.
programmers? No?
I used to do paper charts a long time ago. Well, now I actually put in the levels and click on the highs and lows to run the analysis myself. It's not just like you put in the name and then it does all the work for you. I actually have to do the analysis. So,
Wow. How many
yeah.
instruments do you follow?
I'm probably following about 20 different charts, and I like to do work from the weekly and daily down to probably 30-minute and 15-minute charts. So you have to break this down because I wouldn't ask anybody to say, okay, the August 24th low is key, so I'm going to buy it up here and risk below there, because that's insanity. And that's what I'm talking about as far as going down to the lower time frame chart. So, for example, we knew that the August 24th low was key and pivotal because it was made at the Fibonacci timing cycles. I had a cluster of cycles when that occurred, and then that was followed with buy triggers. Well, after we started pulling back and it started looking ugly again, we knew there was a possibility that we could make the new low, but because we had time and price at the last low, we watched for a possible resumption in the rally above it. And one of the things that we saw was that on a 30-minute chart, you basically had 618 in time of the prior low to high swing as we were testing some support and a pullback. And then that was followed with a new buy trigger. Now, at that point, you don't have that ridiculous amount of risk. At that point, then you're just risking to underneath the retracement decision. Okay? I mean, these markets are crazy, and if anybody's new, they need to be really, really careful. There's no way I would, identify something and not give them well-defined risk.
Yeah, that's part of the game. Before I let you go, you do any work in crude?
Yes, I have. I did do some work where we had some time symmetry, what I call time symmetry, at the recent lows, and that's why we had the heads up to watch for a possible reversal. So I watch and I count the time of prior swings, and I noticed that I had swings of 14 trading days down, 15 trading days, 15, 18,
wow.
12, which wasn't so similar. But then the last swing into the low was 18 trading days. So between the fact that crude oil was extended, you had extended the major swing from like the January lows up to the May highs, you met extensions where moves tend to terminate. And then also we had that timing count. So we had timing for a possible low that showed up right on the 24th.
Wow.
I'll have to say there were a couple of days before that also showed up for a possible low, but the reversals never followed through after that one. In this particular one, after this timing, we rallied for more than all of the prior rally swings, and that's why we're going to watch this pullback for re-entry on the buy side.
Wow, you put a lot of different things together in your analysis.
Yeah.
Yeah, no, that's what it takes. You do your homework. Carolyn Boroden, she's a commodity trading advisor and technical analyst. If you want to learn more about Fibonacci trading, you should check out her book, Fibonacci Trading, How to Master the Time and Price Advantage by McGraw-Hill. Thanks a lot for coming on, Carolyn. And I know you got up early on the West Coast for you, so I hope we can bother you again sometime in the future. Really enjoyed your analysis.
Oh, thank you. I'll post some of the charts on Twitter that I just talked about, so if anyone wants to look, they can go grab them there.
Oh, thank you. That's very nice. Thank you very much.
Okay.